Welcome to Markets in a Minute. My name is Austin Duke. I am financial advisor and chief investment officer for Diamondback Financial Services. We are an investment advisory firm focusing on clients who recognize the need for solid investment advice, who don't want to invest on their own, but still want to be educated through the process. This is the Monday, September 29, 2025 edition. Let's get started. All right, we'll start by looking at stocks as measured by the S&P 500. This is an index of the 500 largest companies in America. Stocks will move up and down on a daily basis for a variety of reasons, and our job is to figure out what moves we've seen, why we've seen them, and where we think we're going from here. The past 2 weeks, the S&P 500 was up about 0.9%, which brings our total year-to-date gain up to about 12.96%. We can see some of the volatility that occurred right after the Federal Reserve had their meeting and announced that they were reducing interest rates by 0.25%, and then had a press conference, we tend to see a little more volatility around those Fed meetings. Things looked pretty good. We had some economic data that's supporting the Fed's decision to lower the interest rates, and the stock market just seemed to be off to the races. We did get a little bit more economic data this week that suggested maybe the economy was actually doing better than the Fed indicated in their meeting, which would potentially lead to a lower probability of interest rate cuts, which is why we think the stock market struggled a little bit here during the last week. But we did get inflation data on Friday, which was in line with our expectations and really isn't showing any significant signs of uncontrollable inflation. So we did see a little bit of an increase here on Friday. When this comes out on Monday, the 29th, again, we're going to be close to the end of the quarter. We would expect the market, or we would hope that the market will be up for the last 2 days. Leading into the end of the quarter. It tends to be a little bit of a market anomaly that we'll see increase in the market right up to the end of the quarter, and then at the start of the new quarter, we'll see a decline. So we would kind of expect to see a couple up days and then maybe a couple days off with some down days starting off the month of October. This is just a chart showing what the market has done over the last 3 months. So back here in June, we were down around the 6,200 level, and we're between the 66 and 6,700 level. We've gone up about 7 or 8% just in the last 3 months, even despite the actual tariff deadline taking effect here in the beginning of August. We were able to muster out a pretty significant gain for the 3 month period. If we look at what's driving the market, we'd like to do this so that you know that it's not just a broad-based increase across the board, but we have a handful of companies that tend to be making the most impact. So this is sorted by how large an impact they have in the market. So NVIDIA with the largest weight at just under 8%, Microsoft at just under 7%. NVIDIA was up, or has been up about 12, almost 13% this quarter. Apple up significantly, and so we can see as far as the contribution to total return, Apple with its double-digit return has contributed a lot to the overall gain in the market. But Apple, NVIDIA, Alphabet, these Magnificent Seven type names, artificial intelligence type names, rounding out most of the top 10 as far as contribution to what we've seen in this market for the past 3 months. And we anticipate that the theme will continue, the trend will continue as long as interest rate expectations are coming down. And we don't see anything to suggest that this is a bubble that's ready to burst. I've been hearing in financial news media and also from clients the concerns about investment in artificial intelligence, and we do think it will be transformative, but we also think there might be some higher expectations of what to expect, and so it may take longer than we might think, and so these valuations that we're currently seeing in these companies may be a little bit too much too soon, and so that could be one reason why we would see a decline in the stock market or in some of these individual names. Next, we'll look at interest rates as measured by bonds issued through the U.S. Treasury Department. We believe that these are the preeminent measure of investment risk. You have interest rates that are factored into every calculation, every valuation for an investment. So, what these interest rates are doing has an impact on how we value the assets we're investing in and whether or not we want to buy or sell or hold, et cetera. So we've got interest rate listed over here on the left-hand side on the y-axis, and we've got maturity lengths listed down here on the x-axis. Short-term rates from 1 month all the way out to long-term rates of 30 years. The solid green line is where we are as of the end of September here. This brown line is where we were a quarter ago, so 3 months ago, and then this dotted green line is where we were 1 year ago. Just we find it very fascinating. This is a yield curve that is in a normalization process, and it's taking a long time just because things tend to take a long time in a large economy like we have. Um, but it's interesting to see that we've gone down from these short-term rates that were significantly higher than the long-term rates, which we classify as an inverted yield curve, which is not a normal way to invest. Typically, you get a higher interest rate for putting your money away for a longer period of time. But for years, ever since the Federal Reserve started raising interest rates back in 2022, we've had this inverted yield curve. And so we're feeling like we're getting back to a point in time, and maybe over the next year, we'll finally complete that process and we'll have these short-term rates down lower than these medium-term rates, which will be lower than the long-term rates, and we'll finally have a normal yield curve again. Um, but if we take out the 1 year, we just look at what's happened over the last 3 months. Actually, well, so we've seen the 1 month rate basically stay the same. These other short-term rates have shifted down significantly. The medium and long-term rates really haven't moved a whole lot in comparison. But one thing I wanted to point out, if we bring in the 1 year yield or curve back in there, the 2 year U.S. Treasury has really been the hinge, and that's where we're seeing the tail on the short end really start to curve down, and these longer term rates start to curve up. And so it's really interesting to see. And um, the 2 year yield, we want to see a 2 year yield that is not very volatile, and that it has a lot of implications into the shorter term rates and the longer term rates. It really does act as a hinge for our future expectations. So there are other interest rates that are tied to mortgage-backed securities, et cetera, but that 2 year rate, seeing that be the hinge point and not move around as much as any of the others is suggesting to us that things have been going well with this economy and in this market, and we've been right to continue investing for growth that we've been able to receive. So if we start seeing a lot more volatility in that 2 year rate, or if we no longer see a normalization happening with the yield curve, then that would be cause for us to be a little bit concerned. Taking a look at where we think interest rates are going. So the Federal Reserve uses a range. Right now, the range is 4 to 4.25%. So we list the target rate as the highest end of that range here. We can derive an effective rate, which right now the Fed funds rate is effectively about 4.09%. And these are our expectations for an interest rate cut at the upcoming meeting. So 0.25% reduction. We're at almost a 90% probability that we'll get that in October. And then definitely by December, and about a 63% probability that we would get a second reduction at the December meeting. If we don't, then we are expecting that second cut to be in January. But ultimately, we're looking for, and we've got the implied rate over here, so showing that we're looking at getting right down close to 3% by early 2027, and end of 26, early 27. That's kind of where the market is expecting interest rates to go at this point. And if that's the case, then we would expect the stock market should continue as it has been Those artificial intelligence theme stocks should also continue to do well with lower interest rates. So yeah, obviously there's risks, and there's going to be days and weeks and months that something's going to come up and give us cause for concern. But as of right now, we're feeling pretty good about where things are and where we're headed. All right, as far as expectations and implications go, just a couple of items that we are looking at or thinking about. Obviously, the Fed cut interest rates, which the market responded positively to. Our second quarter GDP economic growth came out, the final reading came out higher than expected at a 3.8% annualized rate, which is good, but it was still, you know, the flip-flop of what we had in the first quarter, which was negative because of all the tariffs and the imports and exports issue. What I think is going to be more telling is what third quarter looks like, right? We actually had tariffs in place in August, and now we'll have some actual hard data to look at and see how did the economy hold up. Um, we've talked about the labor market. We've talked about how those numbers have come out much lower than we thought, and it's given us reason to think more about the health of the overall economy. I've had some other individuals talk to me about their thoughts on it, and we think there's not a lot of hiring, but there's not a lot of firing. So we think there's people just staying put, and the more that you think about what goes into people moving jobs and being trained and onboarded and everything that goes along with it. There's a lot of lost productivity when people are moving jobs and they're quitting to go take another job and start up, and so it's expensive, right? If you ask anybody in human resources, it's expensive to bring on somebody and train them and get them up to speed. So if you're not incurring those costs and you're not lowering productivity because of it, maybe companies are being more productive and they'll end up being more profitable. And so we're very interested to see if that shows up in third quarter earnings, because we didn't know about the labor statistics until the last couple months when the revisions came out. So at the end of September, we end the third quarter, and within the next 2, 3, 4 weeks, we're going to be getting a lot of third quarter earnings reports. So that's something that we're looking forward to and hoping that if it comes out as we think and might come out, that stocks will respond positively to that as well. The fourth quarter tends to be the best quarter of the year. We get what they call the Santa Claus rally as we head into the end of the year. So we're hopeful that things work out there. There's obviously things that we're concerned about. We may end up having a government shutdown this week if Congress is unable to come to a budget deal. And do tariffs get collected if the government shuts down? I don't know. That could be a very interesting wrench in the whole situation. So we're also watching and wondering if we're inching ever closer to a much larger conflict around Russia and Ukraine than we had hoped or thought earlier this year. It definitely feels like things are expanding as opposed to coming to an end. So we'll just have to keep our ears to the ground and pay attention as much as we can. If we see anything that suggests we need to make a move or make a change, we will. But for now, it's steady as she goes, and we've completed all the rebalancing that we wanted to do this summer, and we're hopeful that we can leave things pretty quiet and just allow things to simmer and grow here into the end of the year. Okay, as a final word, my daughter got married this last week, so we welcome a new son-in-law and congratulations to them. It was a fun day to spend with them celebrating that event. When this goes out on September 29th, that's actually my birthday as well. I am still in my 40s and recognize that I very well could be a grandpa while I'm still in my 40s. We'll see if and when that actually happens, but that's a hard reality to accept. But there is a lot of uncertainty in this world, and it's something that we still have to face on a daily basis. And so seeing these young kids get married, and for me, even in my what I feel is an old age in my 40s, still getting up, still tackling the day and everything that comes with it. That's what we do. That's why we do what we do. And so we appreciate you guys working with us. We are hopeful we can get going on annual reviews and answer questions that you have and make sure that we're still investing appropriately for your circumstances. And appreciate everything that you do for us, and we'll keep working hard for you. And hope you guys have a good week.